Hello, welcome everybody. I am John Cook, the co-founder of GeekWire, and welcome to our virtual webinar today, where we're going to talk about everything related to the CARES Act and the Paycheck Protection Program. We've got a really interactive discussion today, and we're excited to jump in here. I know there are a lot of questions. We've had record turnout here today. We launched this seminar early yesterday morning, and as of just a few minutes ago, I know we were topping our limit at 500 folks. So I know there's a lot of interest here, a lot of questions, and want to make sure that everyone enjoys the discussion here. So just a little bit more about GeekWire. We are a technology news site based here in the Seattle area. Many of you know us probably for our news coverage, which is going on as we're covering everything related to the coronavirus and everything in the business and technology community. You probably also know about some of the events that we host. As you can imagine, those are all on hold right now. So we've pivoted, like many of the companies and businesses that are on this call today, to find new opportunities, and this webinar is an experiment for us, so bear with us as we go through it. And there are multiple ways for you to support our efforts here and the journalism that we're producing each day on GeekWire, through membership, through underwriting, and simply reading and sharing the coverage during these very uncertain times. So with that, I wanted to also thank our sponsors today, Lane Powell and Seattle Bank. They are the sponsors of our Playbook event series, which is a great entrepreneurial speaker series. And as soon as we get through the current mess that we're in, hopefully we'll be back to meeting in person and connecting with all of you. So big thanks to Lane Powell and Seattle Bank. So with that, I just wanted to do quick intros of our panel today. Got a great group of folks here that are really knowledgeable. I learned a lot on our pre-event call yesterday in terms of everything going on as it relates to the CARES Act. So first off, David Nilssen, who's the co-founder and CEO of Guidant Financial, which has helped more than 20,000 small businesses across the country secure financing since it was founded. He was also named the SBA Young Entrepreneur of the Year in 2007, so very familiar with the SBA program, which is core to this new loan program that we're going to be talking about today. We also have Josh Williams, who's the Chief Banking Officer at Seattle Bank. Josh, I know, is very, very busy dealing with this situation and all of his clients that are very curious about how this is going to unfold. We also have Liz Pearce, who's the co-founder and CEO of FreshChalk. It's a new small business recommendation network. Liz is the former CEO of Liquid Planner, and she sits on the board of the UW's Burke Center for Entrepreneurship. And also joining us is Louis Horowitz. Louis leads the tax team at Seattle law firm Lane Powell. So our panel, I know we've got a lot of questions. I don't think we're going to get to all 200 of them, but I wanted to jump in, and I think I'll toss it to Liz and David here. Since you are both really immersed in small business networks and connecting with small businesses, from restaurants to massage therapists to car dealers to across the board. And I just want to get a sense from both of you what you're seeing out there. What are you hearing from the various organizations that you serve?
I'll start. Thank you, John. I've talked to many business owners over the last few weeks. In fact, we did a big survey of business owners to see how they were feeling about where things were a week ago, 2 weeks ago, and are kind of watching how they're approaching the process of getting aid. First of all, it's very confusing and overwhelming for a lot of people. There is, as you already commented on, there are hundreds of questions people have about what decisions to make right now based on the changes that are happening on a daily basis coming from the very highest levels of government. So I think there's a lot of fear and uncertainty about the immediate future as well as the long-term future. People are anxious to figure out how to close this gap for the next couple months in the short term.
And David, how about you? What are you seeing with the folks that you're working to secure capital for?
Yeah, so I'd echo everything that Liz just said, but I'd add that Seattle is an interesting environment because it's we're way ahead of a big part of the U.S. So our clients are distributed all over the country, and I think our clients in Washington and New York and some of these areas that have been harder hit and hit faster than others are certainly feeling it. A more acute pain point. But I think everyone is insecure about what decisions to make. And I'll give an example. Today I was talking to a woman who owns a campground, and she has been, basically she's not an essential business, but she's been asked to host essential businesses. And so there's a question for her even is like, I'm not working, I'm letting these essential businesses that are in nursing and oil sit on my land. But am I even allowed to lay myself off? And getting an answer for that has been really hard. So the pace at which we're able to get information to these entrepreneurs is disproportionate with the speed at which they have to move. So there's a lot of frustration, a lot of uncertainty.
So Josh and Lewis, maybe you can jump in on this. Bank of America, I think, opened up applications this morning. I know from last I saw, their CEO was on CNBC this morning talking about this, and I think they said they had already 10,000 applications coming through and that they were trying to service their existing clients first. How confident are you on a scale of 1 to 10 that the financial system is going to be able to adequately disperse these loans with the volume that financial institutions are going to see? I guess 1 being no confidence and 10 being extreme confidence. Where are we at on the spectrum just to physically deploy this capital?
Yeah, this is Josh. I guess I'll go first. I think, no question that people have talked about, there's a huge amount of need, and especially in Seattle where we've been on, the leading edge of the impact of this, that need's already, well entrenched, and people have been looking hard to be able to find solutions. I think we have a high degree of confidence in just the capacity of the banking system overall. That said, this is a totally unprecedented response, which is good by the government, and the channel that they're using is just not intended to handle this much volume. So I think there's going to be, like so many things we've seen in this process, a period of struggle initially to get this up and running. There's, for example, the initial banks that were approved, lenders have been dramatically increased. We're amongst many banks that are now approved to start processing this. So there'll be new capacity coming online in the coming days. And so I think it's going to be challenging in the next few days and weeks as that initial glut of demand or pent-up demand is hit. And then I think we'll start to see some progress on that. So there's no question it's a heavy lift. It's a lot to do. And I can tell you from talking to other bankers, lenders, and everybody supporting them, people are working sort of all hours trying to get ready and to be able to accommodate that.
Yeah, just from a practical standpoint, Josh, when do you think Seattle Bank will be up and running in terms of being able to process these requests and applications?
Yeah, we've been talking with clients really this whole time. We've got information from clients. So for just a specific example, we're now have approval to basically make loans under this program. But there takes some amount of time for the SBA to basically open up the back end to banks to be able to submit an application, get a guarantee number, and move that forward. Right now we're thinking that's still a matter of days before we're going to actually have those guarantee numbers coming back. And so that allows us to at least work with clients in the meantime to have everything we can get from them up and running. And so we're doing that now, and then hope to be moving, within relatively quickly after that in terms of getting money out and moving.
Yeah, and Josh, what percentage of your clients across the bank do you think have inquired about this program or are likely going to apply?
I'm not sure, but I'd say it's a significant amount. We work with all different types of clients, some of which are businesses, some not. But I think, certainly a significant percentage of our clients are impacted and have inquired about this and are certainly looking at various ways to just mitigate the impact of what's gone on. And in many cases, it's about, how they can support their supply chain or their employees or do other things along those lines. So it's a significant percent. And then the number of inquiries from people that we just know in the industry, other businesses that we've spoken to that are running into capacity issues at their bank or don't have an existing banking relationship, those numbers are probably fivefold, what we're seeing in terms of from our client base.
Yeah, Louis, let me bring you in. Your confidence on the banking system's ability to deploy what looks to be a record number of applications coming in?
And it's not the bank's fault. I think this is, normally there's about, I think 3.5 billion or so of SBA loans in a year. And now we're asking the banking system to deliver 100 times that in the course of a week. We have an SBA that is, they're probably doing their best, but they are so confused. You have a statute that is so incomprehensible. And so they're trying to administer a very difficult program. It's like Congress decided this without asking the banks what it would take to have probably a 5,000% increase in their loan volume. And until yesterday evening, actually, on the East Coast, the banks finally reached an agreement with the Treasury, where the Treasury basically said, okay, we'll basically hold the banks harmless for mistakes, and we won't ask the banks to do too much due diligence. But you're also using a strange system. I mean, the banks have to be the ones to give out the money because they're the ones who have the money. But you're asking bankers, after beating up the bankers after their low doc loans in the early 2000s, now we're asking bankers to basically give out for $348 billion in the course of a week on what is basically a no doc loan. And indeed, even the information that borrowers have to provide the bank, that the bank has to check, is comical because it doesn't relate to the information that's used to determine the amount of the loan. So the banks have to receive information on sort of your 2019 income, your 2019 payroll, but that's almost a meaningless number when compared to how much the bank is supposed to be lending against that payroll. It's a complicated system. They've dumped it on the banks. I really appreciate folks like Josh and Seattle Bank jumping in to help here, but it's a very difficult problem, and I have no idea how they're going to do it, and therefore my confidence is relatively low.
We had a question from Katie Drucker, and it's one I've had as we've looked at this program ourselves at GeekWire, and it's clarifying your view on the loan calculation. Is it trailing 12 months or calendar year 12 months? So is this based on your payroll in the 2019 calendar year?
Maybe. The answer is no. It's based on trailing 12 months, so it'll be the period ending March 31. The information people, but the confusion comes because the statute said trailing 12 months. Then the SBA told everybody they could use 2019 annual. And last night, the SBA, without sort of acknowledging that they sent people in the wrong direction, they said use trailing 12 months.
So that is March 2019, March 2020.
Mm-hmm. What we're telling our clients to do is to submit with it their 5 quarter. We're telling them to submit 5 quarters of their 941s, showing and maybe a W-3 from last year showing their payroll for 2019 and their payroll for the first quarter of 2020. And the bank is auditing largely 2019. All they're really doing is confirming that the gross number has some relationship, I guess, to the number, the amount of the loan request, but it's a faint correlation.
Yeah, John, if I could add to that, I mean, I think, this is it's a huge problem. It's a very big solution. There's complexities. At the end of the day, you know, the recognition was the only way to try to get this much money out, to essentially try to bridge the gap in income that is impacting businesses, is to try to use the banking system because you have distribution. As Louis said, it's a huge, dramatic jump in the sort of activity that would typically happen. But I think, and it is evolving, and it certainly has been frustrating for everybody that's been trying to get a specific definition on it. But the assurances that we continue to get, I think the IFR last night provided more sort of assurance or comfort around this, is essentially, hey, we basically need to exercise reasonableness here. It's up to the borrower to basically certify what their eligible expense is, to show that they've provided information that supports those numbers. And then with that, the SBA is basically saying, use that number, come to a calculation, and get the loan processed so we can get money out. And so I think it's, there's no question there's a lot of details, but I think it's just the whole intent here is to just basically move forward, be reasonable, and try to get money out to businesses that are impacted.
Don, I actually think that's a really important point, because what Louis was talking about is important. I think for purposes of this program, we're being told, hey, let's take this plane and take it off, but we're trying to build it at the same time, right? So we're doing this to help the financial system get dollars into the hands of small businesses. We want to keep people employed. We want to make sure that they're paying the rents and mortgages, so we don't have the real estate market, collapsing underneath us. There's a lot of things that are happening simultaneously, and for that reason, people need to be calm and reasonable. I think there's been a lot of fear pressed into the market that says, hey, there's $349 billion up for grabs. It's first come, first serve. You have to run to your bank and be there 8 a.m. today. But the reality is banks are going to start rolling this out at their own pace. They're going to be rolling it out to some of them to their customers first. I saw one bank today said customers who are banking and lending clients. I've seen one that says we're taking on new customers. I've seen one that said we're not taking new applications till May. Then recently came out today and said, well, actually, we are going to start taking applications. One bank says they need trailing 12. One says that they need 2019 payroll data. The reality is everyone is still trying to figure it out, and we're just going to have to be calm and flexible, all the while still understanding that many of the businesses are in crisis, critical steps. So people are just going to have to be okay with a little bit of ambiguity in the short term while this gets rolled out. But I have every confidence, based on the level of priority this has for us as the world, that we'll figure it out. And if the money runs out, and if there's still an acute need by June 30th, I also, although I can't guarantee it, have confidence that between Treasury and Congress, we'll figure out a way, like we do with the SBA limits, when those get a little tight, raising that ceiling and making sure more capital gets out there.
Yeah, this is a hard thing, and maybe for David or Liz, though, because as you're waiting for that ambiguity as a business owner, you have to be planning not just for the next 2 months, but for the next 12 to 18 months. So a lot of people are stuck in this kind of limbo land, waiting to see if this system will come together and actually even work for their own businesses, while also trying to decide if they have to take extreme actions and cut expenses and cut staff. And so I'm wondering how you're balancing that decision, and we've had a lot of questions to this, because this ties into the loan forgiveness, that if you keep your staff, you can have a fully forgiven loan. And so how are you juggling that dilemma?
Yeah, I've heard from businesses that have, as we've already acknowledged, Seattle's out ahead of the rest of the country on this. So if you look at Q1 payroll for a lot of Seattle businesses, you're already seeing reductions in March. People furloughed employees, hoping to maybe bring them back. And so a big question right now for them is timing. When do they apply? Do they bring those employees back before the demand for the services has returned? That's a big head scratcher. And I think that people are also, echoing what David was saying, really nervous about the first come, first serve, and struggling to process what their bank is telling them with other opportunities that might be available to them. Especially, I think it was Reuters that reported last night that some banks may not participate in this at all. So if that bank is yours and you've been waiting around for them to open their application and they don't, are you at a disadvantage because you could have gone to a different bank that is processing loans for non-customers?
Yeah, I would just add a couple things to that. First, I think no small business should not take action that is critical to making sure the business can thrive in the future. So if there are things that need to be done, what we told our team about 3 or 4 weeks ago was that 2020 plan that we rolled out does not exist anymore. We are now on a 30-day planning cycle, and we're going to continue to work on that short-term basis until or unless the markets, and I say that as the economy and activity starts to calm down. I think it's safe to assume, we just in Seattle got told we're going to get to stay home for another full month. This problem is going to exist for a while, so the businesses are going to have to make decisions quickly, and they should. Now, this particular opportunity with the Paycheck Protection Program is allowing for that, because until you get funding, you are basically operating the way that you can. Once you get funding, you have 8 weeks then to pay people the appropriate salaries, make sure you're making sure your rent and your mortgage and your debts that you took on obligations before are paid for. And so you can rehire people at that point, you can restore pay at that point without fear of penalty, as long as you do it during that period of time. So I think this allows for a little flexibility there. But again, the businesses, until or unless they get funding, still need to do what they can.
But listen, David, you're very level-headed here, and that's very helpful. But the SBA is ringing the bell saying this is first come, first serve. We have the banks saying we have no idea how long this money is going to last. There's a lot of fear in the market that if you don't get in now, you're not going to get it later. I do believe that Congress is going to have to come back and increase the amounts, but who knows if it's going to be this iteration or another iteration. And people are scared. Their businesses are crumbling. They're seeing on both the human scale and the business scale, and they desperately need this money. And the government is, I think, not helping by stoking the confusion and by emphasizing first come, first serve. We don't know when this money is going to come out. There were several issues in last night's guidance. First of all, the idea that you give out guidance the night before you open the window for lending is crazy. I mean, if I were a bank, I would be so furious I'd probably walk away from it. So I admire Seattle Bank's willingness to tolerate the last minute notice. But there's loads of confusion, even in last night's guidance, that is reserved for future guidance. And the biggest issue is portfolio companies of PE companies all are denied access to this largely under the affiliation standards. The PE companies have brought this to the attention of the Treasury. The Treasury said in last night's guidance that they're examining the issue. What does that mean? You've told me on one page that this is first come, first serve, the money's going to run out soon, and in another page you tell me you're going to tell me in a couple days, maybe a couple of weeks, whether or not I can apply. That's not helpful.
You and I are going to be in violation agreement communications before, so we can move past that point, because I agree with you. I am level-headed because we're trying to figure this out as we move, just like everyone else. But I don't want to take away from the emotion in the situation, because I'm a small business as well. My entire business relies on helping small businesses get into business and stay into business. My economic model is fully aligned with our business customers continuing to operate, and so I want that for anybody, not just our customers. But I think at this point, the best thing that we can do is provide good information that helps people navigate this time of uncertainty, and that's all I'm trying.
So we're getting so many audience questions out there, so I want to turn to a few of them. This is one that came in last night. It was, I own a consulting S Corp and I'm the only employee. Work is dried up and I have suspended my salary. Any relief for me in this program?
I'll take that. The answer is yes. You're an employer. You have one employee, but you have an employer, and you're able to submit a loan application. Josh is standing ready to take it. And you ought to be able to cover 2 months of your expenses based upon your last year's salary and your rent, and your utilities, and mortgage interest.
Great. The one confusing part on this, on the loan obligation, is if you do lay off employees, there's some sort of calculation that would be done to get that you'd have to pay back a percentage of the loan. Have there been any updates that you've seen that spells out what that looks like? Josh?
Go ahead, David. You nodded first, David.
Yeah, maybe.
Well, I was nodding that it is true that has been stated. I haven't seen a direct calculation yet created. What we know is that people will have a period, and once they receive funding, they will have the ability to change wages back to a reasonable range. They'll have a chance to hire people back and use those proceeds for that. If there are leftover dollars after the fact, there is some sort of reduction in terms of the amount of forgiveness, and it comes really actually on threefold. So the first one is what we just talked about, is if they reduce the number of full-time staff or have less than the average number of full-time staff than they did within the historical data that they pulled. The second one is the level of payroll. So if the loan forgiveness can be reduced, if they've decreased salaries and wages by more than 25% on people that make less than $100,000. But again, they'll have from the time that they actually taken those loan proceeds to make those things right going forward. So I think there's fairness in terms of the way that they've built this. The business could do what it needs to in the near term, but it is intended to make payroll, and 75% of the dollars that are deployed need to be used for payroll as part of that forgiveness.
And then I think just to add to that, David, which is a helpful summary, if it's restored by June 30th, even if those numbers go down well in the period of use, if those, employment and salary numbers are restored by June 30th, then there would be no reduction. So yeah, I think it does point to an underlying issue, which is this definitely makes much more sense for a business that's trying to cover payroll for the team that they absolutely need to keep around. If there's going to be a long period of structural readjustment and you have to have layoffs, then I think it is worth looking at your cash flow budgeting and finding out, is the best thing you can do for those employees is that they're able to take care of improved unemployment benefits. That might be because we're talking to a lot of companies that are trying to figure out how to be most supportive to their employees. The unemployment benefits might be the necessary sort of safety net for those employees that you're not going to be able to bring back by June 30th. Whereas if you have this core that's going to be there, or if by having them there, if you have the cash to keep more employees, can you pivot? Can you do something else? Those are the areas where this program is going to be the most useful.
Josh, the tough thing there, though, is who's operating a business right now thinks their business is going to get back to normal by June 30th.
Yeah, I think that's a huge question. I think our sort of awareness around that in Seattle is just different than most places in the country, because we just are seeing that. I suspect, we can't count on it, but I suspect that those will be the cases where they'll either use flexibility built into this act, or they'll look at further provisions in terms of whether or not that needs to be extended or not.
So one of the quirks in this legislation was as I understand, for venture-backed companies. So those that have taken on venture capital money, that the way they get classified is not just on their employees, but on their investors in their portfolio companies. So you can imagine a startup with 15 employees. If one of their investors happens to be an investor in Airbnb or Uber, they are kind of out of luck. Have there been any updates as it relates to, and I know Nancy Pelosi and others were trying to get this changed. Certainly at GeekWire, we have a lot of readers who are involved in venture-backed companies. Are there any updates on whether this has been changed, that venture-backed companies might be able to apply for these grants?
Last night's release, which we've shared the link for anybody that hasn't seen it, from the Treasury Department, says that they are studying the issue of affiliation. And that's administrative speak for, we've heard from the PE industry that this is creating a problem for many of their portfolio companies, that the portfolio companies feel like they didn't know that when they took the money from a PE firm that they would somehow have their employees aggregated, and they are asking and the SBA has heard them, and they're saying they're going to provide guidance. I don't know when that guidance comes, and if it doesn't come soon, I really do fear there's going to be a shortage of money.
Yeah.
We are also restructuring some of our portfolio companies. Some PE firms, depending on the portfolio company and their relationship with their investors, are able to restructure their relationship. But think about it. You're asking people to spend time and money and energy renegotiating with, in some cases, your most valuable investor, your partner, and you're saying give up control, give up influence at the same time that you're struggling because you've tossed your budget out. You have no idea what the future is going to bring, and you're going hat in hand to the banks to say, please give me this loan so I can keep my business alive for 2 months. It's an uncomfortable position to be in, and it's a difficult position to be in. And even understanding PE firms are having trouble letting go of their control rights.
Yeah.
I mean, I think I've heard a lot of startups say, is this the point? If you're weighing changing your corporate structure in order to access this capital, should you be instead pitching your investors on increasing their investments so they don't have to reduce their stake and you can keep going? Obviously a tough market for that, but if you're looking at debt or equity or change of control, maybe there are some more options.
Right. We, getting so many questions here. So I'm just going to fly through some of them that we're getting in from, it looks like from Michael Smith. Can I reduce my employee hours so they qualify for beefed up unemployment and still get a PPP loan to pay their reduced wages? Louis or David?
Okay, so I was responding to some of the panelists' questions, so repeat the question, please.
Yeah, it was, can I reduce my employee hours so they qualify for beefed up unemployment and still get a PPP loan to pay their reduced wages?
Yes. It's not, the math is not easy, but you can reduce salaries by, we're figuring for the average business by as much as 40 to 45% without sacrificing too much of the forgiveness. But if you go beyond that level, it will cost you on the forgiveness side. There has been discussion in Congress and at the Treasury Department about changing that forgiveness formula so that you can't reduce your salaries more than 25%, but who knows if and when that will proceed.
David, any additional thoughts there?
I'm curious to just understand where Louis is getting the 40% when you say you estimate people can reduce salaries by 40% in order to not trigger the calculation.
Yeah, I thought it was up to 25%.
Well, it's up to 25% for people who make less than 100. Right. And so he might be
talking you can reduce your high earners.
Yeah. So I would totally agree with that. I mean, I will tell you that I'm aware of many companies that have done a tiered reduction organizationally where they've said, hey, look, the people that make the most are going to give back the most in the near term, where there's a larger pay cut for their HCEs or their highly compensated employees versus their non-HCEs. And so if that's the case, then yes, but it is pretty clearly stated that the reduction of 25% or greater on people that make less than 100K in terms of the salary calculation or the payroll calculation would be an issue for forgiveness.
And to be clear, you can't forgive that aspect of payroll costs related to FICA, either employer or employee share, or the employee share of withholding. So if you figure that your average employee, I'm making up a number, has withholding of income tax withholding of 20%, and you figure that FICA is about 15%, but the employer gets a deduction, we'll call it 10%. That's a 30% cost, meaning that that you can keep your employees on, but if you don't reduce their salaries, you're not going to have the full amount forgiven.
You know, there's one thing that probably important to note too, because as Louis was talking about what is allowed and what is not allowed, you know, the compensation above 100K is not going to go into the calculation for payroll. If you have employees who live outside the U.S., they're not going to be calculated for that. The payroll taxes that he talked about, very true. But yesterday in the interim final rule, they also clarified an issue that was in the initial documentation, which was you could have an independent contractor up to 100K in part of your payroll calculation, but then the independent contractor also had the ability to go out and get a PPP loan. And they said that they're going to withhold the independent contractors from our payroll calculation, and they'll have to go get their own. So for those of the people that are listening who read through this or got the information early, that was a point of confusion that I think should have been clarified.
That is a great point, David, because there have been so many versions of the information. My dad, who is a former small business owner, called me this morning saying, John, have you been looking into this CARES Act thing? And I'm like, yeah, I'm kind of deeply immersed in it. And he's like, well, it's a 4%, 4% on the loan. I was like, no, it was 4%. Then it was 0.5%. Now it's 1%. And I don't, maybe it's changed. Is it still 1% on the loan?
Yes.
Okay, thanks for that clarity.
So, and by the way, I'm not sure that David, I think your description of how independent contractors are treated is what they meant to say. I'm not sure that's what they said. And I'm also not sure that they even have the right to say it because of the way the statute's written. But I'm telling people that I think David's interpretation is correct, but know that there are other interpretations out there.
Well, you know, it's funny. We talked about this earlier. If you look at the interim final rule, it talks about a trailing 12 months payroll. It also talks about the preceding year, 2019. If you look at the application, it talks about 2019 and trailing 12. So there are going to be lots of interpretations until we get a few of these deals through and figure out what the real intention was. And
on an independent contractor, it says independent contractors go and get your own, but it seems to allow it because it's elsewhere. It says that you have to reduce all payroll expenses over 100,000, including amounts paid to independent contractors. So there's a suggestion that you do get $100,000 per independent contract. And how do you open the gates on a lending program like this without speaking clearly about that? Because otherwise you're encouraging everybody to round up on their request. Because if it's most borrowers in distress are not going to round down as a result of an ambiguity. And that puts more pressure on the program.
Yeah. Well, they also said that you can only get one loan, right? So I saw a question in here earlier that said, hey, can I apply at multiple banks? Technically, I guess the answer is yes, but you can only get one loan, right? And you're going to have to certify that you're only going to get one under penalty of perjury. And so, yeah, it's complicated.
And it is complicated. There are I know there are some local accounting firms that have encouraged their clients to apply to multiple banks in case the banks run out of money. We have not done that because I don't think that's either healthy for the system or frankly appropriate given the certification. And I'd hate to see that be used as an excuse to deny the loan. There's also a very strong incentive in this program for banks to lend only to their customers. The first incentive is who doesn't want to treat their existing customers specially, particularly if they are existing borrowers and you'd like them to survive this economic challenge. And secondly, the interim final guidance basically tells the banks that they can rely upon their existing know your customer rules. And if they're an existing customer, well, what bank trying to deal with 10 to 30,000 new loan applications every day wants to get to know its new customer? These are customers in distress, right? So if you don't have a relationship bank, even if it's just a depository bank, I think you're in trouble. And if you're a depository bank, you're a small business and you have one depository bank and you don't really have a lending relationship with them, and they are not an SBA lender, and they walk away from this program, I think you're out of luck. It's going to be very tough.
Yeah, I think the key is to start with your bank. They do know you. You know, all banks want to help. More and more are going to have access to this program, and there are certainly, all of us are looking at what are ways to either partner with other players, or there are other resources out there. So start with your bank. They know you. They're going to be able to give you their best insight on it. Maybe that's with them. Maybe that's with another bank. But the main advantage is if they are doing the program, they do have more information already on you, and that will save you time. I also don't think it's not insurmountable. And I know certainly we're looking at all sorts of ways we can to try to expand that to help as many people as we can.
Yeah, great. Well, I know we've actually got a poll that we can poll our audience with. So Melanie, maybe when you get a moment, you can launch that. Just looking at our group of over 300 folks who are on this and getting a sense of who is going to actually participate or not. So you can take a look at that poll and get a sense of whether folks are going to join in on this program. Got a question about just sole proprietors and how they might be impacted or if they can participate. Any thoughts on that?
Yes, I can't see anybody because I've got this poll in front of me. Here we go. Sole proprietors absolutely can participate. They participate based upon their last year's income. They can also get relief for amounts they spend on rent or mortgage interest, not personal mortgage interest, but business mortgage interest. And in some ways, the way the computation works, it's actually slightly better for independent contractors and sole proprietors, and they should absolutely pursue relief.
And my understanding is rolling out in 2 waves. One is April 3rd today, but I believe the sole props and the independent contractors are part of the second wave, which is April 10th.
Right. Josh, you had just talked about some of the programs that you have. Yeah, there's a question about Bank of America prioritizing existing clients with whom they have a credit arrangement, not just a general banking relationship. And Lewis was touching on this just a moment ago. And the question is, are most banks doing this? And where does that leave small businesses that don't have any debt?
Yeah, I mean, my sense is, this is anecdotal, is that most banks are primarily because just the sheer demand, and in terms of just the number of inquiries that were coming in before we even knew about the program. I think most banks, one, want to take care of their clients because we're a partner. That's part of what they work with us on, and they expect of us is to make sure that we're doing everything we can for them. 2, I think, is just, as it's stated, we're able to move faster because we have some of the baseline information that we're required to get before we could make one of these loans, whether we want to or not. So I think that's where most are starting. I suspect many will try to expand beyond that as soon as they can. But I think another important part of the Act, and I don't know if Lewis or David may have insights on this, but was the intent that there is the ability to expand this to non-bank lenders or not traditional lenders. So that could be credit card companies, it could be fintechs, so some of the platform lenders, whether that's Cabbage or Lending Club. And by the way, we think that makes a lot of sense just because, again, of the sheer scope of what's trying to get done. I think Lewis maybe mentioned at the outset, that there's roughly $3.5 billion in SBA loans done in a given year. The top 100 most active SBA lenders in the 7A program did 8,000 loans in 2019. So this is, if this ends up being average $75,000 per loan, that would be 4 million loans. So clearly there's a capacity challenge there. And so I think the Act does envision expanding this to new types of originators. And I think that will start to open up more resources in the coming weeks, especially for very small businesses, where frankly the inputs are going to be less complicated on their application process. The dollar amounts are smaller, and so more of a fast track solution I think is going to get better accommodated as more tech focused solutions are able to get up and running now that details are available, versus maybe some of the earlier ones where it's going to be naturally a more manual process.
So Josh, that's very interesting. I agree with you, and I thought that was sort of what the SBA was inviting. And I thought it was very interesting because on the one hand, this is without underestimating the cost of getting this program up and running, there's a lot of money to be made with these loans, right? I mean, the loan origination fee is between 1% and 5%. If you believe the government guarantee, and there really is no risk, even if the interest rate is only 1%, given the short term, particularly the short term of what's left after forgiveness, it's pretty small. I think there's going to be a secondary market, but that's the benefit to the banks. The detriment I see to the banks is we're inviting the platform lenders into this space, and they are very good at using that data. And if, whether it's LendingTree or Square Cash or Venmo, one of those folks that are very good at both the platform lending and the data management and mining, once they're in this space, you're not going to get them out. And I think you're going to see them as competitors to many community banks down the road.
Yeah, I mean, I think, hey, big picture, there's no question that competition already exists. If we step back, 3 months ago, that's a bigger issue for the industry. In the long run, we think, technology has a lot to offer in terms of lowering the cost of access to capital, making that easier for small businesses in particular. There's no question that there's a reason banks are held to the standards that they are, and that we have the amount of regulatory compliance burdens that we do, which, by the way, is the chief thing in making rolling this out this fast that difficult, is we're ultimately stewards of public money and public resources and public trust. But, I would say, I think there's just as much likelihood that in this process, those lenders are going to be having to adhere to higher standards to be brought into that. And again, it just comes down to, do you have an economic model that can potentially getting out $10,000 or $15,000 loans in some cases in the speed we're talking about? They will need to leverage technology. And at the end of the day, I think there's some great players out there in terms of the technology side. If this helps bring them up to where they need to be, that's the right thing for the market. Sure, it creates more pressure for the banks, but we're all trying to figure out evolving and competing. That just goes with territory.
So this question's popped up a lot, very technical and acronym heavy, so might need just a little bit of explanation here. Can you use the PPP payments to pay off the EIDL loan? Sorry for all the acronyms there. For those, maybe we need to explain what those are. I think I know the answer to this, but David, maybe you can just do a quick explanation and then answer that one.
Yeah, so quick difference between the PPP and the EIDL. So the PPP is the Paycheck Protection Program. That is 2.5 times your monthly payroll. It's at an interest rate of 1% over 2 years. The payments are deferred for 6 months. There's no collateral, no guarantee, non-recourse, 100% guaranteed by the SBA. And there's a forgiveness option there if you use it for appropriate things. The economic injury disaster loans, or EIDL, are for exactly what they talk about. The economic injury disaster loans are for up to $2 million. They're lent directly by the SBA as opposed to the PPP, which is done through the lending system. They're 3.75% over 30 years. They do require collateral and guarantee, and payments are deferred through the end of the year. Now, people have been able to apply for the EIDL loans for a lot longer. And so some people have actually received that loan, or may have also received one of the grants, because by applying, the first basically 1 million people are going to get a $10,000 grant. There's a $10 billion allocation for that. Up until the applications for the PPP or the program was open, people could get an EIDL loan and then also get a PPP. My understanding though, and there was some confusing language in the interim rule yesterday, so I'll tell you what I believe to be true, but I'd love to hear from any of the other panelists whether they read it differently. What we understand is that you've got to receive the EIDL loan before today in order to be able to have both. If you did previously receive an EIDL loan, then if you used portions of that to use for payroll costs, then you actually have to refinance the EIDL loan in the PPP. So you can get approved for 2.5 times your payroll and then add the EIDL loan amount to that, and then it'll be refinanced together. But if you did not use those funds for payroll costs, then you just keep them separate as is. So that's our understanding of it, but it is a little bit confusing the way that it's written, so we're still looking into that piece.
So for some people, the EIDL is still a better deal. First of all, you've got the $10,000 grant. So if you're a sole proprietor, you're driving an Uber, or were until people stop leaving their homes, you need to be applying for that now.
No question.
Second, for many businesses, the EIDL is a better deal if you can stay under $200,000. The repayment interest rate is higher, but it's a much longer term to repay. And if you don't get a PPP, it's not refinanced into the PPP. And if it's under $200,000, there's no personal guarantee and no collateral. I think they take like a blanket collateral in any other unsecured hard asset. So, if you don't pay, I guess they can come and take your laptop away. But for a lot of small businesses, I think the EIDL is a better deal if they don't have a lot of payroll.
Yeah, that is the key component there. If they don't have a lot of payroll, it is very true. And I'll just put a pinpoint right on what Lewis said. As I understand it, those $10,000 grants have not been fully used up. So anyone who applies on the EIDL, so you have to go basically to the SBA website. It's covid19relief.sba.gov. You'll click on economic injury. You'll fill out the application, and on the application you can check the box that you'd like to receive the grant. And per the SBA, they're supposed to get that grant to you in under a week. So anyone that does that, while funds still are available, will be eligible for that $10,000 grant.
Has anybody actually gotten their $10,000 yet, though? Because I've been encouraging clients, small businesses to apply for that for like 2 weeks now, and I don't know that nobody's called me up and say, "Thank you, I got my money."
That is a good question. Josh, do you have any sense of how quickly these funds are going to be dispersed?
In terms of, I assume, Jen, you're talking about on the PPP side, I think the hope is that it's going to be out, I think there are banks that are hoping that they can get those turned in about a week from the time of application. So, we'll see how that goes. We really don't know. There's the process of basically getting application, making sure the lender can verify the information provided to support the loan amount. And then the lender has to then submit to the SBA to obtain that guarantee number. And I think that's definitely a potential choke point in terms of just the overall capacity. So we really don't know how long that will take. Once that comes back, then it's up to the lender to be able to document and fund that loan. And again, in terms of the variables that are still being determined, as of right now, and I know most lenders I've talked to don't know if there's a specific loan form that's going to be used for that, or if we're intended to develop our own. So those are key details. Now we're certainly, hoping that we'll be able to get clarity on that at the same time that things start processing through and we have guarantee amounts. So, we're working on things in parallel tracks. But that's the process. So I think, if it could be in a week, that would be amazing. I suspect it could be a matter of weeks, but I don't think it's a matter of months. And I know everybody's moving as quickly as they can.
Liz, I'd love to get your entrepreneurial perspective here. I know you've been weighing the possibility of going after one of these loans or another decision. Like, how are you trying to make that decision as a CEO of a young company?
Yeah, I think, we're one of the companies that I guess is fortunate in that we will be maimed but not killed by the coronavirus. I think we have recently raised money, and so we're not planning to lay anyone off or shut our doors, but we will definitely be impacted. And our ability to raise future capital may be impacted. So I think I was talking with someone today who's in financial services, and they said it kind of comes down to some as an ethical decision. If it's first come, first serve and you jump in line ahead of someone who may otherwise be killed, their business be killed by this, how do you make that call? So I'm still kind of on the fence for us as a company.
Yeah, that's a great point. I every morning my routine now is getting up and listening to CNBC, and I'm listening to Jim Cramer on there talking about this. And, he has restaurants, and he's been talking about how he is in this position because he's actually going through the process of potentially applying for these loans. And he's talking about how confusing it is and how he has been able to hire people to come on board, and he's got relationships with bankers. There is a real equity issue here too, that people that do have a deep relationship with a bank are going to have more access to this, and true mom and pops that might not have those relationships are going to get screwed. Is this a concern of others? Or Liz, what are your thoughts on that?
Yeah, for sure. It's as it is with most systems, the people who are advantaged are going to do better. And the people who are really struggling, the mom and pops, the people who may have already shut their doors, are not going to be able to take advantage of it. So I think that may be a big factor in our decision whether to go after it. I hope other companies that are in a similar position will consider it, but I think it does come down to a judgment call.
I mean, it definitely is a concern. And I think, the number one issue is going to be the ability to expand the capacity to get money out there. So, I think Lewis's comments, point to the various complexities of that. Probably most important politically is that if the goal of the government is to essentially make grants to businesses that have been impacted, then they just need to make sure that as we're administering this program, we're really clear about that's what it is. We need to make it as reasonable as possible, as accessible as possible, keep the money flowing, and just to make sure that we'd actually do what it was supposed to do. And I think that's going to be the key to doing it. And I think in the meantime, I mean, I certainly understand, Liz is in from other businesses that are just feeling overwhelmed. I think we just have to hey, let's do it what we can control. I would say definitely apply. And I do think, to David's earlier point, things are probably going to get a little bit log jammed, but then the reality is because everybody's going to be log jammed, then it's going to start to get moving through. So I actually don't think all the money's going to be gone today because it's just going to take time. And so, our sense is that over the next week, more is just going to sort of gradually pay out, and we'll see the impact or the benefit that we're hoping to get out of this program.
David, I know you're an entrepreneur. Are you looking at this program for your own company as you advise others?
Yeah, there's no question about it. I mean, we've been tracking this for quite some time. I think the sort of stages of our response have been, stress test our financials and sort of understand what we need to stabilize our operations to what is a new norm. I don't even think we know what that new norm is at this point. And so in the meantime, yes, for sure, we want to make sure that we extend the runway for not only our team, but our clients to make sure we're there to support them through this. It's a challenging time. I mean, this is a once in a lifetime opportunity to try and survive through a pandemic, and nobody has a blueprint for it. So at the point that we can take advantage of dollars that will help sustain the organization, we will. And so I agree with Josh. Anyone that has been impacted by this should strongly consider it.
Great. I know we're at time here. We've got dozens of other questions. Do our panelists want to hang out here and do kind of a rapid fire on some of these as quickly to try to get as many questions answered? Do we have 10 or 15 more minutes if people want to hang? And for those that were here, we do really appreciate all of your time and support, and hopefully this was valuable. I think we're going to keep going and answering as many of these questions as we can, because I know it's an important topic as we try to sort through this. And I was just going to pull up our poll too here, just to give people a sense. Melanie, maybe you can share those results with us again so we can see how many of our folks in our audience. There we go. So about 60% say they're already working with a lender. 30% are a maybe. Only 3% no, and or 9% no. So very interesting. And then the cash runway question. It looks like we've got 19%. Looks like, people are looking here for a long 6 to 12 months or 12 to 16 months. It's a long, long road to go here. So appreciate everyone filling out those poll questions. So I'm just buzzing through the questions here. Let me pull up the last one. There was a question of somebody defaulted on a $1,500, $50,000 SBA loan. Does that make them ineligible to request the help now if they've defaulted in the past with an SBA loan? Louis, maybe have you looked into that at all, or?
I'm pretty sure that the guidance that came out last night answers that question and says it makes you ineligible.
Makes you ineligible.
That's my understanding. Yeah.
Okay. And then,
which of course is, if you think about it, maybe it's fair. I mean, the person defaulted, but maybe the person defaulted because their business ran into trouble last time. Should that preclude them from surviving the current economic crisis? But it's not surprising that the SBA feels that, once burned, twice shy.
Yeah, understood. Here's another question. If I keep paying full salary to employees with no reduction, will I be able to get the forgiveness on the loan? I heard something about having to reduce their salaries by at least 25% to get the loan forgiven. Clarification, please.
I think
No.
they're here misinterpreting that. It's actually just the opposite. If they maintain their salaries, it puts them in a better spot to get more capital to maintain those salaries. So,
but David, I think I'm understanding this. If you do keep your staff, but you do a salary cut up to 25%, can you still get 100% forgiveness on the loan?
So the 25% applies to people who make their total payroll costs are 100K or less. Above that, when we talked about this earlier, the highly compensated employees, they can reduce wages by more than that.
So if you cut salaries of somebody who's making less than 100,000, you may not be able to get the full loan forgiven.
Correct. And again, I haven't seen any calculations on exactly how that will impact the loan, but they've been very clear that someone that makes an aggregate of 100K or less, you should not reduce wages by more than 25%. Otherwise, it would impact forgiveness.
Right. We have tried to create calculators that allow businesses to figure out the balancing act between cutting and not. There's a reason the SBA hasn't done it, okay? And if you think about it, businesses like predictability, they like guidance. The SBA ought to be able to create a program with a calculator that says, okay, if I cut these salaries, this amount, how does it affect me? Otherwise, you're sending small businesses to very expensive lawyers and accountants.
Right. Another question here. I just did a lot of hiring in early 2020. Is there any chance that banks will work with my last month of payroll so I can keep my new employees on?
Only if you're a new business.
Can you explain that a little bit more? Because I know there's a little more nuance to that.
There's a provision for people who have not been in business for more than a few months. They can use the short term, but if you've just been ramping up, good for you, but it's 12 months average.
Yeah, the
12 months trailing
period is January 1 to February 29th is what they'll look at there. I mean, the unfortunate reality is for people that have been in business a long period of time, they're going to look at the average. And for the companies that are growing and hiring more, it is going to skew those numbers slightly, but that's just what we're stuck with.
Here's a small business owner that pays himself via draws. I assume he's probably an LLC. Can I qualify if I don't have myself on payroll? I think that's the sole proprietor.
As a sole proprietor, he can apply. Not all LLCs are disregarded entities. Not all LLCs are partnerships. So it's hard for me to say, but as a sole proprietorship, he can certainly apply.
Got it. Just going through here. In calculating payroll costs, the Treasury lists the 100,000 salary cap separately from health insurance and retirement benefits. That implies health insurance and retirement benefit is not included in the 100,000 cap, correct?
I spent 2 hours last night debating that issue with my colleagues around midnight. There was not a consensus. The way I interpret the statute the way I interpret the interim final regulation is that health insurance and other benefits are not reduced, only the base compensation. But I will acknowledge that the issue is not entirely free from doubt because it uses the word compensation and without sort of defining compensation. So, I think health insurance, group term health insurance premiums, it's hard to imagine in this environment that SBA would challenge it. Normal employer, retirement contributions probably okay. On the other hand, if you've got some mega retirement contributions being made, you can imagine some SBA pushback. But that complexity and confusion is a result of the statute, and it's a result of 4 people in a whatever amounts to a smoke-filled room nowadays writing the law. They should have thought about those issues beforehand. There's no reason for that kind of ambiguity.
Yeah, and I think, one thing people do need to keep in mind is that as I understand it, when you're calculating the compensation, that also includes benefits, correct?
Payroll costs includes benefits. It uses a new word, compensation, when it refers to amounts in excess of $100,000 in compensation. I can't believe that ambiguity wasn't apparent to the folks at Treasury drafting this rule. I think it reflects a confusion and disagreement at the highest levels about how to compute that $100,000 cutoff. And David, you've looked at this very carefully also. I don't know if you have a different view.
Well, I think I would agree with what you said. I think it's confusing. I think they use different terminology, and because of that, we're not sure how to appropriately map some of those things. But up until last night, we were calculating the wages, the salary, and any sort of variable compensation, plus the severance or separation payments and sick leave and health insurance and retirement benefits, all as part of that calculation. I think that it's fair to say that there's some ambiguity around that, and we're still waiting to get some final clarity. But that being said, my belief is the intention around the 25% that we've been talking about, the reduction, is more around direct compensation. But we'll learn more here in the near term.
Great. Another quick question. They said, we've raised our only employee from 60,000 to 79,000 in January 2020. How can I get the proper coverage for the 8 weeks of the new salary?
Well, as we talked about earlier, they've been in business for how long? Is it less than a year? Is it more than a year? Because the calculation is written based on that, not based on what is a great increase in salary for that individual.
Great. There's another question that's, what happens if I recently hired employees? For example, my trailing average is not the best metric. This is a situation that, and this gets into how you're factoring it, whether it was last year, 2019, or if you're doing it as trailing March 2019 to March 2020. But if you've really scaled up in the last 3 months, how do you accurately calculate that?
I think that goes back, exactly what David just said. It's trailing 12 months. And if you're hiring during the first quarter of this year, congratulations. But and you will get 1/4 of the higher payroll. But unless you're a new business, you're stuck with that trailing 12 months.
Yeah, it is a gap in the regulation, because I think the assumption is that all businesses will have been reducing headcount at this point, right? Versus, hey, some have been on a growth trajectory and now we're going to hit a brick wall because of this. The calculation doesn't account for the latter.
On the other hand, there is still the EATL loan available, and if your business is growing, I'm not sure that this particular program was designed to help you.
Got it. Quick question. Is a 25% reduction for forgiveness calculated individually at the employee level or as a percent of total payroll?
David? So could you ask the question one more time?
Is the 25% reduction for forgiveness calculated individually at the employee level or as a percent of total payroll?
It's 25%. It's on a per individual basis, as I understand it. It's the $100,000 in terms of total payroll costs, which they've defined. And if you've reduced any individual by more than 25%, then that is going to be counted against you in terms of your ability to in total. And I'm not sure exactly how that's going to apply. I've not yet seen anything that would tell us that, but I believe it's on a per individual basis. Now, there may be some confusion there too, because they've also said that you have to use about 75% or more of the forgivable amount's going to come from costs directly related to payroll. So, you know, there's some confusion there, and there may be some confusion there in terms of which one they're talking about.
Yeah. Josh, probably a question for you. What sort of forms need to be included in the package and application?
Yeah, we're developing that list now. There's some specific forms cited in the application that are required, and David has a better memory than mine, so I'm guessing he might know those off the top of his head, but if not, we'll get those out. But the bigger thing is there is still described in the language last night other supporting information that's also required with that. So we're in the process of building out that list. And then if you are in the position of starting a new relationship with a new bank, there's going to be information the bank needs to do to basically verify your background, and KYC or know your customers is often talked about. And so we'll be building out a list of that. So that's certainly something we can show later. In general, the know your customer stuff is going to be organizational docs on the entity and identification docs on the key principals and owners. And then in general, on the eligibility information, it's going to be some of the things that we're talked about here today in terms of payroll numbers, financial statements, et cetera.
One thing I'll just note, so we're not a bank. We help people prepare packages typically to go to banks and get ready for funding. And we're not packaging loans for this particular program. So I'm just speaking on behalf of our clients and the work we're trying to do to help them. But what we've seen from the various banks that we're working with right now is pretty consistently they're looking for the W-3. They're looking for the IRS form 941. That's all summary data for the employer in terms of their payroll, and then also the quarterlies that they do for the IRS purposes. And then yes, for the know your customer stuff, articles of incorporation, their bylaws, their operating agreements, and then a driver's license, things like that. So it's relatively light. Again, you know, as we've talked about here before, this looks more like a grant program masked as a loan, and so they're trying to make the documentation up front very light and a little bit more on the back end. But again, they're trying to make sure we get dollars down to pay people and pay mortgages quickly.
Great. Well, I know we've got a bunch of other questions coming in, but I want to respect our panelists' time. I know everyone is extremely busy right now as we go through this. Any just final thoughts here as we wrap up? And I should note that we have been recording the session, and we're likely going to be posting this full interview on GeekWire, since we had a number of people who weren't able to get into the chat here this afternoon. So any final thoughts here, Louis, as you think about this program and a lot of our small business owners and startups out there that are listening?
I'd say the process doesn't end when you make your application. I'm not exactly sure what's going to happen between application and getting your check because it's unclear whether more information is going to need to be provided. I don't know whether this is you're getting a marker. This is, you know, your number in the bakery saying what number you are, and you have to get up to the counter to put your order in, or whether it's going to automatically translate into a deposit into your account. But there's going to be a lot more paperwork, I think. 8 weeks later, when you're asking for forgiveness, and the banks have 60 days at that point to assess on behalf of the government. All of the incentives are for the banks to be cooperative and lenient in their assessment of of how much should be forgiven, but that's where the paperwork, I think, is going to come in.
Liz, any thoughts?
I mean, it's been awesome to have a front row seat with all of these experts as a small business owner, as someone who works with small business owners. I think, mine is really just a message of solidarity with the small business owners and, a wish for everyone to be patient as they're sitting through phone queues and waiting on email responses and all those things. If there's ways that FreshChalk can help in any way, we would love to. We're starting to help some businesses bring their expertise online. And we just want to help the community any way we can.
How about you, Josh? Final thoughts here?
Yeah, I mean, I think Washington State has been a leader in responding to this overall. We're seeing really favorable numbers, in terms of just containing this. And so, I think with people like we have on the call today, in terms of the work that Liz and David are doing, supporting their clients, all the work that Lane Powell is doing, GeekWire getting the information out. I think we just have to stay positive. Everybody's working very hard. I think David's advice, stay level-headed and just sort of keep on this is key. And, I think we're going to see this be one of a few really important resources. So certainly we're happy to be a resource. We'll end this call and jump literally right into the next call of continuing to build out the workflows to take this business. And, that will be the priority certainly for the weekend and coming days. So I look forward to helping people out as we can.
Thanks, Josh. I know you're busier than ever. David, final comments?
Yeah, I mean, as you've even seen on this call, this is a fluid situation. Even our interpretations of these things are different and ever changing. Yesterday when we did the call, we were talking about 0.5%, and literally while we were on that call, they changed it to 1%. So yeah, I mean, just right now, keep learning, keep being adaptable. Whatever you're asked to fill out now may actually change. The application did change last night as well. So, but I would just also stress too that, the entrepreneurs, all of us are under significant stress right now. The banking system is as well. They want to keep you as a customer. They want to do great things for you. But they're going to have to ask all of us to also adapt to different ways of interacting with them. I'm seeing most of the lenders saying we're going to do this all digitally. You're going to have to go online to do it because we can't handle the sheer volumes. We're just going to have to work through it together. But I would just say hang in there. Like I said, there's no blueprint for this situation. We're all trying to figure it out. And I know that every single person that is a panelist, including GeekWire, is going to be updating content on their sites, their LinkedIn profiles. We're all resources for the community. So feel free to reach out anytime, here to help.
Great. Well, Louis, Liz, Josh, and David, thank you so much. And thanks to everybody for joining us. Also, a huge thanks to Lane Powell and Seattle Bank for sponsoring this session. I have a feeling we'll probably be coming back to update folks since this is such a fluid situation. And do keep tuning into GeekWire to get the latest on the COVID-19 crisis and all the other economic and business news occurring out there today. Stay healthy and safe, and we will see you next time. Thanks for everybody for joining.
Great. Thanks, John.
Thank you. Thanks, guys. Thanks, Liz. Thanks, Louis. Thanks, Josh. Thanks, David.